An old chestnut, ones which you would have seen if it heard my budget from previous years. It's just one which goes up every year, and this increase is certainly to apply for this financial year. So it's an increase from 1st of July 2010. So it's not a typo there. Certainly is to apply from this year. Basically, the numbers you can see there are the numbers, are the thresholds that would apply, and below the amounts, for example, for an individual under 18,839, you don't pay any Medicare levy. So what can we do there? Well, I guess if you are at the brink of that, if you're earning $19,000 as an individual, for example, you might want to try to reduce it through any deductions perhaps. And if you then bring it down to 18,500, then there's no levy, absolutely. Remember, if you're 19,000, then your levy is 1.5% of the whole 19,000, whereas if you bring it down to 18,500, just under the threshold, then there's no levy at all that you would pay. Right? So that's the Medicare levy low income threshold. Now that was a new change that came through in terms of a deduction for a motor vehicle. So this would apply for small businesses. So if you have clients who runs small businesses, your tradies, your small employers who runs a business, this will come in from 1st of July 2012. Remember, this is a write-off, so this is pretty much a cash flow advantage. It is not just a handout of actual dollars. It is really a forward bringing of the deduction. You get a immediate write-down deduction of $5,000, and whatever is remaining will then be included in the general depreciation pool, 15% in the first year and 30% thereafter. I've given the example here to show how that works. For example, if your client, self-employed, bought a ute for $33,960, then the way that before this change comes about, which is pretty much this year, then if you had bought the ute this year, you would simply get a 15% depreciation on it, and therefore your deduction is $5,094 deduction in the first year. With this change, what it is providing is that you will get the existing depreciation plus the $5,000 as well, so $9,344. But what that means obviously is your ute depreciation cost will then be reduced from $33,960 less whatever the $9,344 would be. So it is a matter of bringing forward a cash flow advantage as far as this accelerated deduction is concerned. And if your client, based on the existing depreciation plus the upfront write-down, amounts to $9,344 at a marginal tax rate of 30%, the benefit amounts to $1,275. So that's actual dollars itself. So what can you do as far as your clients is concerned? If your client's thinking about purchasing a ute or motor vehicles for business use, then perhaps you might delay it till 1st of July, in which case then obviously you get the cash flow coming through a lot quicker. But before you do that, obviously if your clients are into salary packaging as well, then we need to consider is it worthwhile obviously taking the deduction against salary packaging, and how else we can make it even better than that. So think about your clients, think about your self-employed, think about your sole traders who is running a business. Then would it be an advantage to take the $5,000 immediate write-off there? So now the tax offset changes, there are a few of them here, and the first one is the ETO. That will be abolished from 1st of July 2012. I think that's been around for a year or two at least, and what the government is saying is that it has not been effectively used, and therefore it will be just abolished. A couple of other ones which are interesting as well to consider. A dependent spouse tax offset. That's quite a significant dependent spouse tax offset. So in the past, where if your client has a dependent spouse and meeting the requirements and perhaps not working and staying at home, then there would have been a tax offset of $2,286 based on the current year dependent spouse tax offset. So that's quite a significant loss there. And from 1st of July 2011, they will no longer be available for taxpayers with dependent spouse under age 40. So I guess the idea with this is in the budget, there's encouragement for, I guess, participation in the workforce, and this is one of the changes. You'll see later on there'll be quite a number of other changes which encourage participation to get back into the workforce. So there's a main theme that goes through the whole budget, and this is one which affects directly the tax offset itself. Now there are a few exemptions there. So firstly, if it does not apply for taxpayers with children eligible for FTB Part B, so there's allowance for that, and certainly doesn't apply for a dependent spouse who is a carer or who is permanently unable to work. So watch out for those classes of exemptions. So it doesn't cover all spouses. Certainly those ones who are exempt will continue to have that offset itself. Now, the other change which came about is the low-income tax offset. I've mentioned earlier on about LITO for minors. So that's totally no longer the case for those under age 18. But with the general LITO itself, what the government has done is to not change the entitlement itself, which is $1,500, but certainly to provide the case that in the PAYG to allow a higher amount of the LITO to be claimed during the year, as opposed to at the end of the year when you do your tax return. So what this is doing is that it does allow a $300 receive upfront, if you like, during the year, as opposed to having to wait till the end of the year when you put in the tax return. So it's it is a bit of a benefit, but it's more of a cash flow advantage, if you like. Not really that excited, but I guess in difficult times, $300 over the current year, as opposed to waiting for your tax return to be done post 31st of October, is still better than nothing there at all. The question was asked of, I think, Julia Gillard just the other day about why didn't we just provide the full amount instead of 70% of LITO spread over the year. And I agree with her answer there, and that is, there are times when we could have overclaimed on certain other expenses, and therefore we could have been overpaid during the year. So this gives a bit of a margin such that we are not claiming 100%, and therefore we're having to have a tax bill that would, perhaps work to this total disadvantage anyway. So that's the reason why it was done at 70%. So a bit more to come back when one puts in the tax return in due course. So a good benefit, a good cash flow advantage, but not really that exciting, but something well worth remembering, I guess, for your clients.